Welcome, everyone. Today, we're going to take a journey into the heart of the global oil and energy markets. Our focus is not on rumors, not on hype, but on how these trades actually happen. We'll examine three pillars of modern petroleum trading. First, the real supply chains behind jet, A1 aviation fuel, D2 diesel, and LNG. Second, the step-by-step process from RFQ to final delivery. And third, how oil trade deal structures are evolving in 2025. By the end, you'll understand not just the language, but the logic of the oil trade world. Let's begin. Section 1. Jet. A1, D2, LNG. What real supply chains look like. To understand oil trading, we must start with the physical. After all, we are not dealing with abstract paper, but with molecules of energy that move across continents. Let's start with Jet A1 aviation fuel. Jet A1 is the lifeblood of global air travel. Its chain begins at the refinery, where kerosene fractions are refined to strict aviation standards. But refining is only step one. From there, Jet A1 enters bonded storage tanks, usually located near major airports or dedicated terminals. Why bonded? Because aviation fuel is high value and tightly controlled. Quality is everything. The fuel is filtered, treated with anti-static additives, and tested repeatedly. From storage, Jet A1 moves by pipeline directly into airport depots, or in smaller markets, it's trucked in by specialized tankers. The supply chain is designed to minimize contamination and delay. Even one impurity can ground an airline. Now, D2 diesel. Diesel is the backbone of industry and transport. Unlike aviation fuel, D2's chain often includes blending terminals. Refineries may produce different grades of diesel, but blending ensures consistency with local sulfur specifications, whether it's ultra-low sulfur diesel in Europe or higher sulfur tolerances in Africa. From blending terminals, D2 is shipped in bulk to regional distributors. Trucks, buses, ships, and generators all run on this backbone fuel. And note, diesel markets are often more price-sensitive than aviation fuel, making logistics efficiency even more critical. Finally, LNG, or liquefied natural gas. This chain is radically different. LNG begins at a gas field where natural gas is extracted, cleaned of impurities like CO2 and water, and then cooled to minus 162 degrees Celsius until it becomes liquid. That liquefaction reduces its volume by about 600 times, making transport feasible. The LNG is then loaded into cryogenic tankers with specialized containment systems. Upon arrival, it goes to regasification terminals, where the liquid is warmed back into gas and injected into local pipelines. Notice the capital intensity here. Liquefaction plants, LNG tankers, regasification facilities. The barriers to entry are immense. So here is your first lesson. Every commodity, jet, A1, D2, LNG, has its own distinct infrastructure, risks, and choke points. Traders who ignore these differences fail before the contract even starts. If you don't understand the physical chain, you don't understand the trade. Section 2. From RFQ to delivery. How to structure oil trades. Now that we've covered the physical side, let's move to the paperwork. Real oil trades live in documents. It begins with the RFQ, the request for quotation. This is where the buyer formally asks for a price and availability. The RFQ specifies product type, quantity, delivery terms, and location. A refinery buyer might request 100,000 metric tons of D2, FOB Rotterdam. Or an airline might request 500,000 barrels of Jet A1, CIF Dubai. Precision in the RFQ sets the tone. The seller responds with an SCO, a soft corporate offer. This is not yet a contract. It's an initial document showing willingness to supply under certain terms. If the buyer accepts, then we move to the FCO, the full corporate offer, which is more detailed and legally binding. Once the FCO is accepted, the next step is the SPA, the Sales and Purchase Agreement. This is the backbone contract. It covers delivery schedules, quality standards, price formulas, inspection procedures, penalties for default, and dispute resolution mechanisms. In today's world, most SPAS reference international standards like INCO, TERMS, and ASTM testing protocols. But here's the crucial point. Contracts alone don't move oil. Banking instruments do. Typically, the buyer issues a financial instrument like a letter of credit, or LC. Sometimes, in higher risk markets, a standby LC or performance bond is required. These instruments secure payment so the seller has confidence to release product. Once financing is locked, logistics are arranged. A cargo of D2 might be loaded at a refinery terminal, inspected by SGS or Saybolt, and shipped with a full set of documents: bill of lading, certificate of origin, quality certificate, and insurance policy. At the discharge port, inspectors test again to confirm product meets specs. Only then does final payment release. The lesson here is clear. Oil trades are not just about barrels, they are about sequencing. The RFQ, SCO, FCO, SPA, banking instruments, shipping, inspection, and final delivery, they form a chain. Miss one link, and the trade collapses. Section 3. Oil trade deal structures that work in 2025. Let's move to the heart of the matter, how deal structures are changing in 2025. In the past, deals were often simple: cash against documents. Buyer pays once the bill of lading is presented, seller delivers product. It was straightforward, but risky. Fraud, non-performance, and mismatched expectations were common. Today, the industry is more sophisticated. Hybrid deal structures dominate. Take Jet A1 deals, for example. Many are now rolling contracts where product is delivered CIF into bonded tanks, but payment is secured by a standby LC with partial prepayment. This gives the seller liquidity to lift the cargo, while giving the buyer assurance that funds are locked in. Another modern structure is the escrow-linked LNG deal. LNG shipments are high value, often hundreds of millions of dollars. Here, payment is released in milestones. Once the tanker is loaded and inspected, once it departs, and finally once it discharges at the regasification terminal. This staged approach reduces counterparty risk. We also see greater use of performance bonds, where the seller posts a bond that is forfeited if they fail to deliver. In return, the buyer may post a pre-advice of payment, proving funds are ready. These structures reflect a balance: security of payment for the seller and security of delivery for the buyer. In 2025, regulators and banks are also more involved. Compliance checks, KYC, anti-money laundering, sanction screening are mandatory. Deals without transparency simply do not close. If you hear of an offer promising large cargoes without banking, inspection, or compliance, it's almost certainly fiction. The lesson is this: the deals that work in 2025 are layered, structured, and transparent. They spread risk across documents, banks, and inspections. Anything else is theater, not trade. Section 4. How to spot real versus fake trades. Let's pause here and apply what we've learned. How do you spot a real trade from a fake one? A real deal begins with supply chain capacity. Does the seller have refinery allocations, tank storage, or shipping slots? A fake deal usually has none of this. A real deal uses verifiable banking instruments: LC, SBLC, escrow. A fake deal asks for upfront fees or promises unrealistic returns. A real deal is backed by third-party verification: SGS, Saybolt, Intertek. A fake deal dodges inspection. And finally, real deals always follow sequence. Fake deals try to skip steps. They might ask for payment before inspection or demand a buyer sign an SPA before proving supply. remember the professor's rule. Sequence is everything. Section 5. The strategic takeaway for traders. So, what does this all mean for you as a trader, broker, or buyer? First, master the physical chains. If you don't know how Jet A1 moves, how D2 is blended, or how LNG is shipped, you can't assess risk. Second, respect the paperwork. The RFQ, SCO, FCO, SPA. These aren't just letters, they're milestones of trust. Third, embrace structured deals. Hybrid models with escrow, standby LCs, performance bonds, and rolling contracts are the language of modern oil trade. Finally, cultivate patience. Oil trading is not about quick wins. It's about sequencing, compliance, and reputation. Those who follow the structure prosper. Those who chase shortcuts fade out quickly. Conclusion. In this session, we've walked through 3 pillars of oil trading knowledge. We explored the real supply chains of Jet A1, D2, and LNG. We mapped the step-by-step process from RFQ to final delivery. And we studied the deal structures that actually work in 2025. If there's one message I want you to take away, it's this. Oil trading is not mysterious, but it is disciplined. It's a system of physical chains, financial instruments, and structured documents. Master the system, and you can navigate the industry with confidence. Ignore it, and you'll spend your time chasing shadows. Thank you for joining me, and I'll see you in our next lesson, where we continue to uncover how global trade really works.